Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Okay, so let's just dive right in. The subject today is X3 Holdings, ticker XTKG, and it is a perfect and frankly brutal case study. It really illustrates how aggressive financial engineering can intersect with these incredibly complex market mechanics, especially in the microcap world.
We're looking at a stock that just closed at $1.60 on December 16th, 2025. And that was after a really volatile day where it touched 169 on volume that was, over 22% higher than its daily average. So the real question we have to tackle is this. Is XTKG's near-term price action dictated by forensic market structure mechanics, things like low float dynamics after a split, mandatory buy cycles, or is it just anchored by the catastrophic fundamental reality? I mean, we're talking massive operating losses and, the inevitable need for cash. I'm going to argue that the structural setup and the technical forces are the immediate dominant drivers here.
And see, that's where I have to push back. I just can't agree on the dominance of those forces. I mean, sure, the technical movements are dramatic. They capture headlines, and, that's what brings in the speculative money. But I maintain that the midterm and long-term price is fundamentally capped by the company's absolutely dire financial condition. All that structural friction, it creates temporary noise, some explosive volatility, yes, but insolvency, that creates a kind of overwhelming gravitational pull that dictates the ultimate destination.
Well, let's unpack that structural friction, because I really don't think it's just noise. It's an engineered setup. XTKG has basically pivoted to survive through what I'd call financial engineering. They're treating their own stock as the main product. The fundamentals right now are, I think, secondary to the mechanics. You have to look at the 1-for-20 reverse stock split they did back in November 2024. That move consolidated shares, it created this temporary scarcity, a tight float, and that is perfect fuel for volatility. But the real kicker, the real mechanism, was a simultaneous SUSIP change on November 22nd.
The SUSIP change. Just an administrative change to the securities ID number. Yeah, I know where you're going with this. Exactly, because that change forces brokers and clearinghouses to reconcile their books. They have to close out short positions that were opened under the old SUSIP. This friction often triggers what are known as fails to deliver cycles. And if those FTDs persist, SEC Rule 204 kicks in. Now, what that means is that brokers must execute price-insensitive market buy orders to clear those fails. It's mandatory, it's structural, it's price-agnostic, and it is the single most powerful driver of these violent short-term spikes. It's completely untethered from the balance sheet. And that's why the December 16 movement was so strong. It was amplified by the stock crossing above its 50-day moving average, a golden cross, which triggers all the algorithms to start buying. Okay, I see the argument. The Golden Cross, the Rule 204 mechanics, they provide explosive fuel. But that temporary mechanical shift, it just cannot sustain itself against the absolute catastrophic financial reality this company faces. Let's talk about that reality. For the first half of 2025, the company reported a $5.77 loss per share. That is an astronomical figure. The net profit margin is hovering around negative 855%. I mean, just let that sink in.
It is a devastating number. I will grant you that.
It is, and it dictates the company's destiny. The most critical metric here is solvency. XTKG has less than 1 year of cash runway left. This isn't theoretical, it's a clock ticking down to zero. And that fact forces management into the classic death spiral financing trap. They have to continually issue new shares, selling them at deep discounts just to cover their losses. This dilution is a perpetual threat. It acts as a hard ceiling for any rally, regardless of how many technical triggers or FTD cycles you see. And historically, we've seen the result, right? Serial reverse splits have basically reduced the position of 4,800 shares from June 2023 to about one single share today. That is extreme. It confirms management is focused on just staying listed, not generating profit. And that creates this deep supply of sellers who are just desperate to get out the second any liquidity appears.
Let's address that supply of sellers, though, and the skepticism specifically through the lens of dark pool shorting, because it feeds right back into the structural setup. The data suggests you have large, sophisticated players making aggressive, directional bets based on the structural weakness, the low float, the high volatility, not just the long-term value. In early December, the FINRA short volume ratio was frequently over 50%. It hit a remarkably bearish 56.69% on December 4th.
And what do you think that high short volume actually represents?
It represents an extreme short interest, right? It's facilitated off exchange in dark pools, so it's happening away from public view. And this extensive shorting, it actually creates a structural vulnerability. If the mechanical triggers we talked about, the CUSIP-related FTDs, sustain some buying momentum, these massive short positions are just structurally vulnerable to a forced squeeze. And that's where the mechanics override the fundamentals, at least temporarily, because mandatory covering orders just do not care about a $5.77 loss.
I'm sorry, but I just don't buy that the dominant force is squeeze potential. I'm not convinced that ratio is about a setup for an explosion. To me, it reflects rational, institutional hedging against what looks like certain failure. Yes, it's directional bearish speculation, but that speculation is driven by the unsustainable cash burn. Dark pool shorting just lets institutions place big bets against the stock without tipping off the public market, which is exactly what you would do if you believed a company was fundamentally going bankrupt.
But the sheer volume is the key here. When over half the daily volume is shorted in private venues, that's an extreme position.
It's an extreme position based on an extreme financial reality. That persistent high short ratio is an undeniable, continuous structural headwind. It's not just fuel for a squeeze. It's a mechanism that prevents any meaningful price recovery because the institutions know this stock has to capitulate to that colossal loss eventually. Every time the price ticks up, there are thousands of shares waiting to be shorted into the move. The brief relief we saw, where the ratio dropped to 34.87% on December 5th, that just let the stock breathe for a moment before the headwind picked right back up. And, let's shift from trading venues to corporate strategy, because this speaks directly to the valuation problem. I call it diversification. The companies pivot into these high beta assets, crypto mining, renewables, AI, agritech. It has almost no operational synergy with its legacy digital technologies business. It's strategically incoherent. It's really just a way to mask slowing growth in their core business.
Diversification. That's a strong term.
I think it's accurate. This disjointed thesis creates what the market calls a conglomerate discount. The market inherently struggles to value a company that's trying to manage farming ventures and mine Bitcoin at the same time. That complexity is a massive fundamental anchor. No amount of technical trading can resolve that core valuation problem. I mean, why would an investor choose XTKG when they could just invest in a focused AI or crypto pure play?
That's a compelling point about the conglomerate discount, but I would frame that pivot very differently. This isn't about creating operational synergy. It's about capital attraction and narrative creation. Pivoting into crypto mining intentionally pegs a part of the stock's correlation to Bitcoin's volatility. That creates a narrative hook that attracts automated trading flows, algorithms scanning for AI or crypto tickers, and crucially, it attracts speculative retail capital, the high-risk lottery ticket traders.
So you're saying they pivot into Bitcoin mining just to get better tickers?
Functionally, yes. It injects external liquidity that enables the technical movements we're analyzing, regardless of the balance sheet. The stock is being valued not as a software company with an 855% negative profit margin, but as a leveraged high beta proxy for BTC. And in the short-term market, liquidity is often more important than profitability, which brings us right back to the durability of any rally. The low flow, coupled with the FTD cycles from the CSUP change, confirms that the price can spike vertically on no fundamental news. And these structural conditions are precisely what the mercenary short-term traders are trading. They're swing trading the mechanics, not investing in the business model. They provide that sudden buying pressure that trips the technical triggers like the golden cross, which then forces the institutional shorts to react. This is just pure market plumbing at work.
I see why you emphasize the power of the mechanics in the short term, but you're neglecting the psychological factor here. The critical ceiling is what I'd call retail fatigue. Think about the shareholder base, the serial, aggressive dilution turning 4,800 shares into one has mathematically destroyed trust. The sentiment has completely shifted from the typical, hodl mentality to a cynical management versus shareholders dynamic.
And how does that affect the price?
But this lack of diamond hands ensures that retail traders are now incredibly quick to sell into any liquidity spike. They see these technical rallies, like the Golden Cross, pushing the price to 169, merely as an exit ramp. It's an opportunity to get a fraction of their losses back. And that behavior transforms the liquidity you cited into a liability, because every technical spike meets a fresh supply of sellers. Those investors are effectively confirming the price ceiling, ensuring that any capital raise has to happen at a severely discounted price point.
But if the SEC mandate forces a buy order under Rule 204, even if retail is selling, the institutional short covering still has to happen. Doesn't that mean the structural factor wins, at least for the duration of the squeeze?
It wins for 72 hours, maybe, but the solvency clock keeps ticking. The mechanical factor is temporary and it's self-limiting. The fundamental requirement to raise capital to cover those massive losses is permanent, and it forces management to constantly dilute. A 3-day squeeze at $1.80 is meaningless when the stock has to be diluted at $1.56 weeks later just to keep the lights on. The fundamental imperative always reasserts itself.
So to summarize my position, XTKG is functioning as a highly sophisticated market mechanics laboratory. While the foundational financial reality is, it's undeniably grim, that negative 855% margin isn't sustainable. The immediate price action, the strong volume spike, the golden cross, the 160 close, that is a direct testament to the power of capital structure engineering. The deliberately low float combined with the FTD cycles is the dominant short-term driver. Right now, XTKG is a trade on technical volatility, not fundamental value.
And to summarize my position, that structural volatility is ultimately just noise when the solvency clock is ticking this loudly. The $5.77 loss per share and the less than 1-year cash runway create an overwhelming gravitational force the company cannot escape. The threat of another round of dilution, which is required to cover these operational holes, ensures that the fundamental bear case remains the path of least resistance and dictates the non-negotiable price ceiling.
I think the case of XTKG really demonstrates that sophisticated market friction can cause stocks to trade as these structural instruments, totally divorced from traditional valuation, at least for sustained periods.
Absolutely. And it also shows why investors have to look at forensic accounting data right alongside market structure data. One side provides the explosive mechanism for a short-term move. The other provides the long-term destination. And the ongoing challenge for any observer is, while weighing which of those forces, the temporary mechanical friction or the permanent fundamental gravity, will ultimately determine XTKG's survival.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.